Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to this week's episode of the Prime Property Finance Podcast. In this episode, I'm going to just dive into what happens when your mortgage deal comes to an end, whether that be on a residential or a buy-to-let product. So when your deal comes to an end, this is all the steps that you need to consider and the thought process you need to go through in order to make sure you have the best deal. Let's jump in. When your fixed rate mortgage deal comes to an end, most lenders automatically move you onto their standard variable rate, which is otherwise known as the SVR. The issue with SVR is that it's almost always higher than the competitive rate that you were on. So let's say you were on one of those nice, juicy, low rates starting at around 2%, maybe even with a 1 from 5 years ago, and you're now moving on to the standard variable rate, which can be anywhere from 5 to 7%, and in some cases even higher. So when you've come off that deal, there's a huge jump potentially. And so you need to deal with that sooner rather than later. As an example, on a mortgage of £250,000, the difference could mean paying between £300 and £400 a month more than what you actually need to pay. And ultimately, that's wasted money. Who is this for? So anybody basically whose deal is coming to an end, whether that's on a residential mortgage or a buy-to-let mortgage, at the end of the period, whether that's a 2 years, 3 years, 5 years or 10-year deal that you signed up for, and whether that be a tracker or a fixed rate mortgage, that deal will come to an end. Even if it's a variable rate, some of those variable rates are what's called a discounted variable. So they give you a discount off the variable rate, which means at the end of the period, that discount finishes and then you move on to their standard variable rate. So your payment will go up. So what do you need to do about it? So the sooner you can get this sorted, the better. Most people fall into the trap of just not realizing that the deal has ended. They may have missed the letter, they may have missed the email, ultimately they're too busy to look into it, especially when the school holidays and things like that. Mail gets put to one side and they just get too busy. And then the next minute they realize is when the mortgage goes out to the bank and it's a lot higher than what it used to be. Other people assume that switching is complicated and when it isn't. And they also think that they may not qualify for a new deal because their circumstances have changed. Maybe they've changed jobs and reduced their income. Maybe they've had credit blip or something like that. And also other people just think that the current lender will automatically give them the best option available in the market. And unfortunately, that's not true. What we're seeing a lot of now is lenders reaching out to people early on in the process and making it really easy to get a new deal. And, saying you're at a few clicks of a button, you can get onto a new deal. Now, we are seeing lots of issues with this because people are signing up for deals that, one, aren't necessarily the best in the market, and two, they're not getting any advice on that, in which case they're not taking in their circumstances, their goals and plans for the property and move-in or renovation or anything like that. And so you end up, we've seen people tie into deals that they didn't want to because they hadn't considered all of the other things that goes with remortgaging your property. So what's the best thing to do about it and how do you go about getting the best deal? So the first thing you need to do is know your dates. Check when your current deal ends. And obviously it's normally 2 or 5 years from when you last did it. And then you can usually start looking at a new deal 6 months before expiry. And then when you get to 6 months out, you can start exploring your options. You don't have to stay with your current lender. You want to speak to a whole of market broker so that you can compare, the thousands of deals that are out there. A lot of brokers have access to exclusive deals that you won't see online or anywhere else. So be sure you do check the whole of market. And whilst the deal that your current lender is offering you may look good on the face of it, there may be better deals out there. Staying with your existing lender generally is an easier process. Ultimately, you've got three options when your deal comes to an end. First is you don't do anything and you just go on to the standard variable rate. Obviously, this may be an option to you because you may be looking to move house in the near future, and so you don't want to tie into a new deal because you want to have your options open when you are looking to sell the property. It might not be looking to sell, may not be looking to move home. You just may be looking to sell the property, and again, you might not want to tie into a new deal. Number two is then you get a new deal from your existing lender. And like I said, this isn't always the best deal in the market. And then three is you remortgage away from your lender to another lender. And this is just like, shopping around for a new deal as you would with anything else, like your car insurance or home insurance or anything like that. So three options available to you. Understand the process. If you stay with your existing lender, it's called a product transfer or a product switch, which are generally quick and simple. If you switch lenders, then it's a full remortgage, and then there's some extra work involved in that, such as the valuation and legal work. However, you can save thousands and thousands of pounds by switching, and so a little bit of extra work is probably worth the additional effort. And then just understanding the true cost. Don't just look at the interest rates. You've got to factor in the fees, any incentives, and any flexibility. A slightly higher rate with no fees can actually be better off for some people. And so just making sure you understand what fee structure is on the new deal that you're looking to take out. And the key thing to think about here is if you don't do anything at all, then you fall onto the standard variable rate. You could be paying thousands of pounds unnecessarily every year. And that's good money that could go towards a sort of family, a holiday, or just even overpaying the mortgage so that you reduce the debt that you owe to the bank. So if your deal is coming to an end in the next 6 to 12 months, don't leave it a chance. Reach out to us at Prime Property Finance. We're happy to review your options, handle all the paperwork, and make sure you don't get caught in the standard variable trap. It doesn't necessarily have to be with us, but just make sure you get advice from a good broker. There's plenty out there. And if you need any advice, please give us a shout. And thanks for listening. Thanks for listening. Hopefully you enjoyed that episode. And if you did and you got value out of it, then please share with somebody who may also get some value from it. As always, if you enjoy the content, please like, subscribe and share, and give us a review, because it really does help us get in front of more people and add as much value to them as we can, as we hopefully are with you. Thanks very much.